In the late 1980s on Wall Street, money was moving fast, confidence was high, and risk still had that dangerous habit of looking harmless, right before it turned deadly. Traders built positions, firms chased returns, and the machine kept growing. On the surface, modern finance looked smarter than ever, more sophisticated, more controlled, more advanced. But underneath that polished surface, something much more fragile was taking shape. Markets were getting bigger, more connected, more dependent on assumptions that could break all at once. And for one man in particular, that lesson did not arrive as a theory, it arrived as a shock. That man was Larry Fink. Before BlackRock became one of the most important institutions in modern finance, Fink was a rising bond executive at First Boston. He was talented, ambitious, and deeply involved in the fast-moving world of mortgage-backed securities, one of the financial innovations that helped reshape Wall Street in the 1980s. At the time, these instruments looked brilliant. They promised efficiency, they promised liquidity, they promised a new way to package and distribute risk. But finance has a pattern that repeats throughout history. The more elegant a system looks, the more dangerous its hidden assumptions can become. And then one of those assumptions broke. Interest rates moved in a way the models had not fully accounted for, and Fink's desk lost around $100 million. That was not just a bad quarter. It was the kind of loss that changes the way a person sees the world. And that moment matters. Because BlackRock was not born from triumph. It was born from failure. It was born from the realization that modern finance was becoming too large and too complex to run on optimism, intuition, and surface-level confidence alone. Fink learned something that would shape the company he later built. In the new financial age, institutions that understood risk best would not just survive the system, they would become central to it. So the real story of BlackRock does not begin with a giant corporation. It begins with a man who saw how easily the machine could slip out of control, and decided to build a new kind of firm around that fear. In 1988, Larry Fink and several partners, including Robert Capito, launched what would eventually become BlackRock under the umbrella of Blackstone. At first it did not look like the birth of a future giant. It looked like just another financial venture in a city full of them. But from the beginning, the DNA was different. This was not meant to be just another firm chasing deals. It was built around risk analytics, fixed income management, and the idea that understanding exposure at scale would become one of the most valuable capabilities in all of finance. Where earlier Wall Street titans had built power through forceful personalities, relationships, and aggressive expansion, Fink was building something colder and more modern, a system, a method, a machine for seeing what others could not yet see clearly enough. And that difference became more important as the world changed. Because the old world of finance had been easier to imagine. Banks made loans, industrialists built factories, oil companies controlled energy. Wealth had a face, and power had a visible center. But by the late 20th century, that structure was shifting. Pension systems were growing. Retirement savings were flooding into the markets. Insurance companies were sitting on massive pools of capital. Institutional investing was expanding, and millions of ordinary people were becoming tied to markets they did not directly understand through retirement plans, mutual funds, and professionally managed portfolios. Ownership was spreading outward, but decision-making was moving inward. That was the opportunity. BlackRock grew in exactly the kind of environment that made this new model valuable. The more global finance expanded, the more investors needed institutions that could do more than chase returns. They needed institutions that could measure risk, map exposure, and navigate volatility across increasingly connected markets. This was not glamorous power. It was not the power of a railroad baron buying senators, or a steel king dominating an industry. It was more technical than that, more bureaucratic, more infrastructural, and because of that, it was also easier to underestimate. One of the clearest expressions of this new kind of power was technology. Over time, BlackRock built and expanded Aladdin, a platform that helped institutions monitor portfolios, model risk, and understand how financial positions might behave under different scenarios. To outsiders, it may have looked like software. Inside modern finance, it was something more important. It was visibility. It was control through information. It was the ability to understand not just what assets were owned, but how they might behave under stress. In older eras, power came from controlling land, labor, or oil. In the age BlackRock was helping define, power increasingly came from standing closer to the data, the risk, and the systems through which capital moved. And yet for years, BlackRock's rise remained relatively invisible to the general public. It was growing, it was expanding, it was becoming larger and more important. But for most ordinary people, it still was not a household name. Then the modern financial world delivered the kind of crisis that reveals what truly matters, and what was only pretending to matter. In 2008, the global financial system cracked. What had looked sophisticated suddenly looked reckless. What had looked diversified suddenly looked contaminated. What had looked liquid suddenly froze. Banks collapsed. Confidence evaporated. And the entire system seemed to reveal how fragile it had become beneath its polished language and mathematical complexity. And in moments like that, history always asks the same question. When the machine breaks, whom does the system trust to help put it back together? This is where BlackRock's story shifts from corporate success to historical significance. As governments and central banks scrambled to understand collapsing assets and toxic balance sheets, BlackRock was pulled closer to the center of the response. It advised, it analyzed, and it occupied the kind of position institutions gain only when they are no longer seen as peripheral players. In calm times, markets can look broad and decentralized. In a panic, the true architecture reveals itself. Some firms are merely participants. Others are woven into the fabric of how the system stabilizes itself. BlackRock was increasingly becoming the second kind. And then came another turning point. Passive investing. This was one of the most important financial transformations of the modern era. For generations, investing had been sold as a contest of judgment. Pick the right stock, find the right manager, beat the market. But over time, a different idea gained momentum. Instead of trying to outsmart the market, just own the market. Low-cost index investing and ETFs began pulling in enormous amounts of money from ordinary savers, retirement accounts, advisors, and institutions. The idea sounded rational, it sounded efficient, it sounded democratic, and in many ways it was all three. Every financial revolution changes more than it first admits. In 2009, BlackRock acquired Barclays Global Investors, including iShares. That deal transformed the company. It did not just make BlackRock bigger, it moved BlackRock much deeper into the bloodstream of global capital. Through ETFs and index products, through retirement exposure and broad market access, and through the machinery of passive investing itself, the company became something unusual. It was no longer just a manager competing for a slice of the market, it was becoming one of the main channels through which the market itself was increasingly held. That is the paradox at the center of BlackRock's rise. It did not need to conquer the world in the theatrical way old empires did. It did not need to own every company outright in the simplistic conspiratorial way people often imagine. It only needed to become central to the structures through which everyone else owned pieces of the world. That is a much quieter form of power, but it is also a much more modern one. And this is why people often feel something unsettling when they try to understand BlackRock. Not because it fits neatly into cartoon villain narratives, but because it does not. It is not a government, yet it can operate close to government responses in moments of stress. It is not a central bank, yet it exists in a world profoundly shaped by central bank liquidity. It is not the market, yet it has become deeply embedded in the mechanisms through which markets are accessed, priced, and held by millions of people. It sits in that uncomfortable space between participant and infrastructure. And that is historically important. Because once an institution starts to feel like infrastructure, the language of power changes. You are no longer talking only about wealth. You are talking about position, about dependence, about what becomes difficult to imagine the system functioning without. Think about the evolution here. The 19th century gave us industrial empires. The early 20th century gave us banking dynasties and oil magnates. The late 20th and early 21st centuries gave us something more abstract. Giant asset managers, ETF ecosystems, risk platforms, and capital flows so large that the institutions coordinating them began to shape the terrain itself. Capitalism did not disappear, it changed form, and BlackRock became one of the clearest symbols of that transformation. This matters because the story does not stay inside Manhattan boardrooms. It reaches outward into retirement accounts, pension funds, market structure, corporate voting power, and even the psychology of ordinary savers. A teacher buying into a retirement fund, an office worker holding an index product, a pension board allocating capital, a central bank responding to a crisis, a major corporation facing shareholder pressure. All of them live, in one way or another, inside the world this transformation built. The old financial order was easier to point to. The new one is harder to see, because it often hides behind efficiency, diversification, and institutional language. And that is what makes it powerful. So what is the lesson in the BlackRock story? It is not that one company secretly controls everything. That is the lazy version. And it misses the deeper truth. The real lesson is more serious. In modern capitalism, the most important power often does not look dramatic. It looks technical, neutral, professional, necessary. It does not need to declare itself openly because it operates through systems other people already depend on. And once scale, information, and capital flows converge inside the same institution, that institution can become far more historically important than its quiet branding suggests. Larry Fink did not build BlackRock by acting like a robber baron from an earlier century. He built it by understanding the century that was coming, a century in which risk would be modeled, ownership would be fragmented, capital would be pooled, and influence would increasingly belong to the institutions standing closest to the machinery beneath the market. That is why the rise of BlackRock is not just a business story. It is a chapter in the history of how financial power evolved after the age of visible empires. And if you want to understand the world we live in now, you have to understand that shift. Because the names are different today. The language is cleaner. The tools are more technical. The structure is less theatrical than the age of Morgan or Rockefeller. But the old question of financial history never really went away. It only changed shape. Who stands closest to the system through which money moves? And that is why BlackRock was never just about investing. It was about power. If this gave you a new perspective, don't forget to like the video and subscribe. History speaks. Those who listen win. Stay well.